now we are going to start our panel. So let me just talk a little bit about our guests, and they are going to introduce themselves more fully in a moment. So we have Tiffany Augustin. She is representing the traditional approach today. She is a partner at Endurance, and I want to make a shout out for Endurance's resources page, a wonderful page if you're getting started out. So take a look at that. She began her career as a business analyst at McKinsey, and her career was in private equity. Then we have Jordan Carter. He's CEO of Blaze and Associates. It is a full-service grant consulting firm, and when he is not CEOing, he has been a searcher and a partner of Search Investment Group, and they support self-funded searchers. He started out in M&A. We have Greg Geronimus. He and his partner did a search. They acquired Smart Tours, a value-oriented tour company in 2019. They launched Footbridge Partners 2, which is coaching and partnering with top searchers. And he started out in private equity. Drew Gottenberg is the founder and managing partner of Spur Acquisitions. Spur's approach is to find the jockey first, meaning the CEO or operator, and then work with them to find a great horse and to set the course for operating the business. He started out in investment banking in the renewable energy project finance space. And then Robert Graham works with Jordan, and he is CEO of Pillar Health Group. He started his career out on the product operational side, which I have a strong affinity for, was a production supervisor and associate product line manager with Lockheed and then Eaton. Our panelists are going to say more about themselves in a bit. Why don't we start with Tiffany? Tiffany, why don't you describe your journey?
Sure, happy to. And Karen, thank you so much for having us and organizing such a helpful session. We're very excited to be here. So I'm Tiffany Augustin. I'm an investor with Endurance Search Partners. We are an investment fund that's focused in the search space. We've been investing in search for the better part of the last 12 years. And during that time, we feel very fortunate to have had the opportunity to partner with over 200 searchers and make over 90 portfolio investments in search-related businesses. Almost the entirety of what we do is focused on traditional search, so very excited to share with you more about that model today. And I'll just say up front that Rich, Larry, and I at Endurance are extremely passionate about the opportunity to partner with very talented early career executives to accelerate their path to becoming a CEO. And we very much see this hopefully as the start, just the start of a lifetime of partnership across their career. So that's a little bit about us.
And then why don't we have Jordan and then Robert go?
Sure. So this is Jordan Carter. Just real quickly, just want to say that it's a pleasure to be here today. Thank you, Karen, for assembling us all together. What's most relevant to you all is that I recently acquired a company last year, self-funded, and came together with Aaron Blick and Robert Graham to form Search Investment Group, really to help our former selves. That's really what it was all about. I know that self-funded searching is becoming more and more interesting to people as they pursue this big world and path, and yet you go alone. So Searchfunder does an excellent job of creating a community, and where we fit in is as experienced advisors and actual operators to help those searchers close deals and on the best terms they possibly can. But yeah, background-wise, I'm in Texas now. The company is 100% remote that I purchased, and grew up here, did undergrad, business school, and then self-funded searched.
My name is Robert Graham. I'm partners with Jordan in Search Investment Group. So a little bit more background. Actually started my career as an engineer on the operational side. to what Karen said. And then ended up buying a group of healthcare companies in 2019. It's called Pillar Health Group. And, when we did that, we actually were lucky enough to end up with a great investor group, and one that was comfortable with self-funded search deals and great terms. And so soon after acquiring those three companies, I actually helped, several searchers raise equity. And we had great success with those equity raises. And so we decided to fund SIG, Search Investment Group, really with the purpose of helping searchers all the way from, very first launching a self-funded search, all the way up to closing a deal, and making sure that the searchers we work with end up with the best, the best outcome and terms possible. So, have gotten to invest in, I've been in 7 self-funded search deals in the last year and a half. So we've seen a lot of things, and excited to continue to invest and be involved in the self-funded search space.
And Drew?
Yes, thanks for having me. Excited to be here. I think with in terms of personally, my background started in investment banking out of college, and had an opportunity to join a client of mine, which was a venture-backed startup, and we grew that company quickly through multiple rounds of capital and unprofitably. And the position of having to continue to funnel money into a company multiple rounds was exhausting. And so when I heard about search funds as a thing, it was, first of all, just a very enlightening, kind of eye-opening moment, as I think it is for most of us. And as I became more and more aware of the ways in which people approach this this path, it became clear that there's a lot of different ways to go about it, and excited to represent kind of this general category of accelerators today. But ultimately, even within that category, there's different approaches. And so from Spur's approach, we like to blend a lot of elements of the model together, but really focusing our investments on a very select small group of individuals who we back with 100% of the capital and resources, which comes along with our full team and the support and the infrastructure that we can bring by pooling our resources together to kind of create a lot better tools and a more of a repeatable process to really help enable the process of identifying and evaluating companies to buy. And then marrying that with some of the elements of some of the other models of diversity of the LP base to bring in more mentorship and kind of seasoned investors and experience and network effects that come from the individual groups that can come together around an opportunity, all trying to really put the people that we back in the best situation for them to be successful. We launched in 2019 and started with 3 individuals. We acquired 2 companies last year, and I'm in New Hampshire in the process of raising capital for our 3rd deal. And we have 5 more operating partners. We call them operating partners, searchers, joining us this year. So that's me.
So I want to have a Greg talk, and I want to give a huge shout out to Greg because he was probably maybe the 5th member on Searchfunder, or one of the, after me, Mark, and Luke, and Susan. So I want to thank you for your long-term support. Thanks.
Oh, thank you. I'm grateful to be here and grateful for all the work that the Searchfunder team does. I wish we had Searchfunder when I was in business school and contemplating search. Really just a remarkable resource. And I think there's probably more to it than most people realize. So encourage everybody to spend some time on the platform to check it all out. So by way of background in my journey, had private equity investing experience before decided to do something entrepreneurial. Went to business school to try to figure out what that would be. had no idea what a search fund was. A sign of the times now, if you're entering business school, you've probably already been on Searchfunder or read the Stanford primer. But back in 2010 to 2012, it was a much less known, well-known concept. So my section mate, friend, business partner, and I decided to do a funded search, but also a geographic search. So at the time, we needed to be in the New York, New Jersey, or Connecticut area. So we looked only in those 3 states, saw a lot of deal flow, ended up going a little bit off the middle of the fairway and bought a tour operator, company called Smart Tours. Bought the business in 2013, a year into our search, operated for 4 years under our ownership, and then sold in 2017. Had a 2-year transition period that brought us to mid to late 2019. But in the process of transitioning out, decided to create the second iteration of Footbridge Partners, which, as I believe sort of Jordan and Robert put it, is sort of catering to what we would have wanted when we were searching. So we do invest in traditional searches, but with a twist and our own approach. And our twist is really about sort of focus and really close, intense collaboration, and just being, incredibly supportive partner. So just as Drew mentioned, bringing in different sort of elements of the model, we draw some inspiration from accelerators and incubators, but we also see tremendous merits of the traditional model. So we sort of position ourselves somewhere in between the two, providing the benefits of having a diverse investor group while also and all the support that comes with the traditional model, but also, that really, just unwavering and endlessly available partner that we try to be.
Thank you, Greg. Now we're going to switch back to Tiffany. And Tiffany, I'd like for you to talk a little bit more specifically about the traditional model, maybe the personal factors and economics that might guide someone to want to do the model, and then why you feel that you're a unique and in a beneficial way for searchers.
Sure, happy to. And I don't know if you have the slide, or I can share my screen as well, but if you don't mind putting that up. Just wanted to provide a brief overview in terms of what the traditional search is all about. And it really has 4 stages, as some of you might be familiar with, which I'll cover briefly. In terms of the first stage, it's really around raising the search capital itself. So raising that sort of 400,000 to 500,000 of capital from 10 to 15 investors to help cover your cost over the course of a 2-year search. The second stage, as you all might know, is actually going out and finding and acquiring the business. Usually something that takes sort of 2.5 years. During this time, in a traditional search, you'll work very closely with your investors. Just as an example, we tend to work, very, very closely, particularly once the deal is under LOI. But even up front, in terms of getting ready to search, all the organizational efforts that go into planning to search and building an organizational sort of team to do that. Once the deal is under LOI, oftentimes investors will play a critical role, even in meeting with the owner of the business to confirm that there's sort of capital behind them, reviewing underwriting models, helping to flesh out a business plan, leveraging kind of templates and tools from searchers who've come before you, helping to put together 100-day plans, helping to finance bank debt, and introduce you to lenders. There's kind of a whole range of sort of the nuts and bolts of getting a deal done and completing diligence that most people who go into search have never done before, unless they're coming from a private equity background. So it can be really scary. And the ability to sort of leverage that know-how from across sort of a broad investor base of 15 investors who are at the end of the day partners in your search, I think a lot of people find quite helpful. The third stage is running the business. This is the exciting part, being the CEO of a business. Usually at this stage, you'll have put together a board of directors, which will have anywhere from 3 to 5 members, largely drawn usually from your investor base on the traditional search fund side. You'll run the business, execute on a value creation plan, And then after a period of time, which, historically is generally tended to be sort of 4 to 7 years, but there's a lot of flexibility around that, then you'll exit. A lot of times, actually, people end up staying on and continuing to be the CEO of the business, but sometimes they exit and go on to do other things. And one of the more interesting things that we've seen recently is a shift towards traditional or recently exited search CEOs going on and raising a second traditional search fund or doing something similar within the community. So that's kind of the model at a high level. And I think the key to it, and some of the questions you asked in terms of the advantages that we'll get into more, I think in the context of the discussion, is the key is that it's really around partnership, and the partnership between the searchers and their investors. And one of the things that we find so exciting about it is the opportunity to partner, directly with the searcher, but also to sort of that diversity of perspectives that you get in the context of being a part of a traditional search in which there's, the searcher and then the 10 to 15 investors that they put together in the context of putting together their fund.
Thank you, Tiffany. And I'm going to switch up the order a little bit. I'm going to have Drew go next. And Drew, you were going to share a slide.
Yep. Okay, does that work?
Yep, it's working.
Okay, great. So in our organization, we refer to our searchers as operating partners. And this slide is a basic overview of what we do with for our operating partners. And it comes down to a lot of the same elements that many other members on the panel have talked about, which is support in the form of a partnership. What our operating partners want to do is to go find a business that they're well equipped to go be CEO of and grow and allow that business to really realize its full potential and do so as quickly as possible. So we have invested a significant amount of our time and resources into building a CRM and a database infrastructure that enables this search and allows us to continuously build relationships with potential future sellers. The majority of the people that you talk to in your search are not ready to transact yet, but every business is going to go through that process at some point. With Spur being a central point of contact, we have the ability to continue to nurture that relationship over the course of time. So when that business owner is ready to sell, they'll have a positive impression and reach back out to generally somebody who's already operating a business. But that relationship stays with us and is for the benefit of all of our future operating partners. We represent ourselves as an institutional grade investor with a quality website with individual bios, and we're building a track record of acquired companies in our portfolio that gives assurances to the business brokers and the investment bankers that we can actually execute the transaction. There's money behind it, and there's people with experience that gives people a sense of comfort that they're dealing with a professional organization. We also spend a lot of time taking the administrative aspects off of the plate of the searcher. So accounting, bookkeeping, banking, tax prep, the payroll processing, insurance, state registration, entity formation, regulatory licensing, the documentation, NDAs, templated, all of those materials. And this allows for our operating partners to really focus on assessing the opportunity, the fit with the seller, the needs of the business, and whether or not they're equipped to really bring those to the table to create the equity value that ultimately is your payday as a searcher. At the end of the day, it's the incremental value that you create. In addition to all of that, much like with traditional search, as well as how you would do it going about it yourself, you have access to a network, and we offer our network to you. And for your benefit, that's not just myself and my business partner, Mike Pilot, multiple full-time staff members who work on our operating partners' behalf exclusively to help them source deals. we have an attractive value proposition to interns who want to have experience across multiple phases of the deal cycle. And with multiple searchers on the platform, they can see sourcing, they can see the LOI negotiations, they can see due diligence, and they can see the capital raise and the closing process as well. You know, what we've learned going through this is that there are nuances to this market. I think that's an understatement, but there are lessons that you learn in going through this about how to approach conversations and how to allocate your time most efficiently that you really have to learn by going through it, but it can be reinforced when somebody like a fellow operating partner or myself and Mike can kind of take those learnings and really translate them into actionable next steps, right? So you don't have to necessarily make the same mistake over and over again until you really understand what the better approach is. We've gone through it with our searchers time and time again. So those are the ways in which Spur generally focuses on adding value in the process.
So we'll go to Greg next. Hey, Greg, you started to share your screen, but you were muted earlier.
All right. Can you hear me and see the screen?
I can, and so can my dogs.
Wonderful. So I just wanted to build on some of what Tiffany mentioned and shed a little bit of light on the economics of the traditional search fund model, and perhaps pre-butt or proactively address some comments that will come in a moment. But basically, the way that the economic sort of package works for a traditional searcher is that they have the opportunity to earn up to 25% of the common equity effectively, or if they're a solo searcher, or 30% if it's a partnered search. And while, you know, you might hear about other models or read on Searchfunder about opportunities to own a significantly higher percentage of the upside of effectively the common equity. I think it's important to keep in mind that size matters, and the scale of the company and the opportunity is arguably a much even bigger driver of the economic opportunity for the searcher. And as you can see here, I won't go into too much detail, but you know, if you look at two fairly typical structures side by side for traditional and self-funded, and you know, even though a self-funded searcher can have, you know, up to 80% of the equity, the common equity, whereas a solo traditional searcher can have about you know, about 25%. You know, given the size and scale of the opportunities, there's really not much of a comparison in terms of the of what you can make. And money's not everything, and people are motivated to go down the self-funded path for many reasons, and there are many great reasons. But I do think that there's a common misconception out there that equity ownership percentage, people conflate that with the economic opportunity, and it's not the same thing. So I just wanted to address that because I think that I hear a lot of questions about that as I talk to potential searchers. Also wanted to emphasize not just the economic opportunity with traditional search, but the mentorship opportunity, and building upon several of the things that Tiffany mentioned. But with our focus, we work with 2 to 4 searchers per year. The norm, and you know, just different approach for a lot of traditional investors is to back 15, 20, in some cases, you know, 25 or more searches per year. But our focus is very intentional, and it allows us to be really helpful, value-added partners. We have 2 deals under LOI with searchers right now. We found both of those companies. We source extremely actively. We're on the phone with sellers from, initial conversations, trying to establish credibility and help get the deals moving along down the funnel. After this panel, I'm going to drive 2 hours north to meet with the seller to try to get them to select us or select one of our searchers. So that's just the spirit of how we operate and collaborate.
Thank you, Greg. Now we are going to turn to Jordan and Robert, bringing up the self-fundeds. So they agree that I could spotlight Robert, but I'm going to do both of them.
Actually, Karen, we can show our slide.
Okay, great.
Get a slide too. So I'll see if I can do this share screen. All right, can everybody see that? Okay.
Yes.
Yeah, Robert, do you want to go ahead and give an overview of this slide?
Yeah, happy to. Thank you, Jordan. So this is a slide that we put together showing, a comparison of the three models. And then off to the far left, the SIG model, which is the, kind of the self-funded accelerator that we've created in Search Investment Group. So, typically with a self-funded search, to Greg's point, you can earn up to, well, not earn, but you can secure, somewhere up to, 80%. I've actually even seen higher than that, but 50 to 80% of the deal owned by the searcher. Traditional search, that tends to be much lower. I think 25%, that's the maximum that you can usually get. But I think it's important to note that, in the Stanford study, I think the average searcher ends up with significantly less than 25% of the company in the end. So yeah, that is definitely not, definitely not the outcome for quite a few traditional searchers. And then, in the accelerator model, it's a similar percentage owned. At the end of the search, if you hit certain benchmarks and stay with the company for so long. So management control, I think a really important point to make, on self-funded searches, searchers almost always keep majority control. They really own their own business. They set the strategy. They are the business owner. There are some minority investors as well, but there may be minority investors, I guess I should say, because self-funded searchers can fund deals on their own. But generally speaking, the self-funded searcher maintains full control of the business. With traditional search and accelerators, you really are an employee with equity upside. In many ways, it is not, truly owning your own business, right? You do have some ownership, but you are an employee, which is neat. It's nice to be CEO of a small business, but for people who really want to own their own business, I think that the self-funded route is really the only way to go. On diligence and capital raising support, the one downside of self-funded searching is there's not much support with that, and with traditional and accelerators, there really is quite a bit of support with capital raising because you've raised capital already, so you already have an investor team. When you go to raise for your actual acquisition. That being said, with the self-funded search space, deals get funded all the time, and they get funded on great terms. And if you work with someone like SIG, we've funded every deal that we've brought to the market, no problem. In addition to that, I mean, it's typically the terms you're getting are very attractive, right? So, like we said, 60 to 80% of the equity. On diligence support, I think that the traditional search investors will say that they provide a lot of diligence support. I've heard different things from different traditional searchers that I went to school with, and just anecdotally, but I can tell you on the self-funded side, there's really very little support in terms of diligence. Now, we created SIG to kind of fill that gap, right? So we actually provide a very high level of support. I spend an hour to 2 hours every week with the searchers that I work with. and Jordan has as well. So it's a very high level of support, which I think does a great job of filling really the gap that's left in the self-funded search model. Credibility with sellers, intermediaries, and investors. The self-funded search model, you don't have that backing there. Sometimes you can put together a board, like an observation board, or something like that. But it's tough to have credibility with certain other parties and sellers. With Search Investment Group, which we created to help with that. Instantly on day one, you've got a commitment letter that we're willing to issue. You've got a board already of advisors put together. And then you've got a track record of the team you're working with, right? That has closed multiple deals in the lower middle market. Traditional search and Search Accelerator, you do have the backing of your investors, which can help. Now that being said, if you started searching at all, you'll know that to some intermediaries, searchers have gotten kind of a bad taste in certain intermediaries, with certain intermediaries. So it may not be as helpful as you think it's going to be. And I'll also mention most sellers have no idea what a search fund is anyway. So when you show them your board of search fund investors, I don't know how much difference that's going to make. On restrictions on deal selection. So, I mean, that's another thing about the self-funded search. That's a benefit. You can really pick any deal you want. You're calling the shots. You're the captain of the ship. On the traditional search and accelerator model, you have, some control of that, but at the end of the day, you have to pick a certain type of deal that fits in a certain box. And that gets harder and harder. The more searchers there are, and the more competitive the lower middle market is. So all things to think about. And on the SIG side, we're just like a self-funded search in that way, and that our searchers are able to pick any deal they want. But I think that's a good kind of comparison between the three. One thing I will say that's commonly brought up is that you can do a bigger deal with the traditional search route, and I disagree pretty strongly with that assertion. So that assumes a lot of different things, but you can do just as big of a deal with the self-funded search model. You just don't lock yourself into 25% maximum equity. You just go to investors after you've already found the deal. And I've seen it happen. You can get, you're probably not going to get 80% of the equity if it's a very large deal, but you're going to get better terms than 25%. And if you just think about it, I mean, logically, as a searcher, it would be very frustrating to me to find a great deal. And it wouldn't matter how great of a deal I found. I would only end up with, it's actually 8 1/3% of the equity when you close the deal. So if you buy a 5 million EBITDA company for 3 times, or 1 million EBITDA for 10 times, you're going to end up with 8 1/3% of the equity, period. And that is completely the opposite of the self-funded search space. You're rewarded for how good of a company you find, how good of a deal you bring to the table, right? The investors will reward you for that, because you should be rewarded for it. And there are solutions out there outside of, the SBA has a $5 million cap, but there are solutions outside of the SBA that can allow you to buy a company that's much larger than what was alluded to in the last slide. It doesn't have to be a 1 million EBITDA company. You can buy much larger businesses than that, using a combination of SBA and mezz debt, using a combination of SBA and conventional debt, using SBIC funds, and even using conventional financing, and then bringing a deal to investors after you've already secured the deal.
Yeah, just want to add real quick. I know this goes a little bit along here. I just want to add a thing to Robert's point. We helped a searcher close a deal with 2.3 million in EBITDA, which most people think that's impossible with a self-funded search. And he kept 70% of the company. Another point also, yeah, Greg, great Excel showing of that. The difference, I think, fundamentally here is not so much about economics of the equity exit. Certainly buying a larger business and owning a small portion of a large business that goes, does a 4X is going to be awesome. You're going to make a lot of money. I think the difference is, as to Robert's point, we're owners. So you're the owner of the business. You're not just the CEO. You truly do control your destiny. You want to sell the company in 3 years? Go for it. You want to hold it for 20 years? I mean, go for it. It's really your company. And also, once you pay off that SBA debt, you will have, let's say, 80% access to that annual cash flow. So it's not just your equity payoff. You can start ripping down, using $1 million annually as an example, $800,000 a year, and putting it in your savings account if you'd like to, or you can reinvest it back in the business. It's your company. So it really is a different person. I think we've talked about this before, but I think the person who wants to go traditional or accelerator truly is a different human being than somebody who even thinks about self-funded search. And yet that's very scary. Self-funded search is incredibly scary. You're alone. You probably may or may not have a deal background, which we actually think is a disadvantage if you have a deal background, because you think you're going to know a lot about this micro private equity space. It's completely different. Robert and I both came from private equity backgrounds. I would say I was at a disadvantage because I tried to use tools and methodologies and treat LOIs the same kind of way I would as a middle market private equity investor. You can't do that. So anyway, it's a lot of support that we're just trying to help our former selves, and we're going to bat for the searcher. That's also the difference, is that we are not trying to maximize investor return. We're actually trying to maximize searcher equity hold and then solve for an investor return. By definition, that's going to be a better solution for the searcher. But that's a good overview right there.
Thank you. I'm going to switch to Greg now. In the interest of time, and I know that Drew must leave at the end of the hour, so I want to make sure we get everybody in. I know that a lot of you have talked about the pros. I want to actually talk about the cons of models. And we've talked a little bit about the economics and maybe more on the personal side, whether it's the geography reach of the search, the industry of the search, any cons from a personal perspective on the models. So Greg, you are up.
I will address that, but I gotta correct some facts first. So I did do a traditional search. Not once did I ever feel like I didn't own the business. I never felt like an employee. We sold when David and I said to the board that we think that it's a good time to sell. It never felt like an employee. I know what it feels like to feel like an employee. That they night and day. I bring up the Stanford study here because this is the known quantity. This is the path that people have taken to, generate those great outcomes in search. This is what a search fund is. Nobody knows how the self-funded experiment will play out. I just think that's fact. There is no study. There aren't many exits or outcomes at this point. So I think it's important for people to contextualize that. One quick correction: 8 1/3 is misleading because you double that just by time vesting. And I also want to correct one thing: this comment about you need to pick a certain type of deal. That's just not true. There are so many traditional search investors with a wide variety of interest in industries, geographies, types of deals, so on and so forth, that if you have a deal that you have high conviction in, that's a fundamentally good deal. Even if it's outside of the box, you will get it done. The downsides of the traditional approach, and I'll just cover traditional broadly in the interest of time, is that I think it's a flexibility thing, and I think it's flexibility as it relates to just like anytime you take capital to do anything, you have a mandate. So if you take capital to search and then, 3 months later, somebody offers you the job of a lifetime that you never thought you'd get and you can't turn down, then pretty uncomfortable to take that job. Or you have an idea for a startup, you probably don't want to go start that, you're probably not going to start that company, although that's happened and potentially could work with traditional investors. So I think it's a flexibility piece. And so I would concede that point, but otherwise I think there are a lot of misconceptions about traditional search that are highlighted by less traditional investors.
It was like a good time to switch over to Tiffany. Do you have further thoughts from what Greg said?
I think everything Greg shared was tremendously apt and appropriate. I think just one more thing on the flexibility point to Greg's, broad argument. It is a model that has shown tremendous sort of flexibility. We at Endurance back 80% of the deals that our searchers bring to us. And those range in anything from software and high growth to more traditional value-oriented deals. They range in size from 1 million EBITDA businesses to recently, several deals actually that required raising 30 to 50 million of equity capital. And I would challenge on the folks on the self-funded side to present some examples where people repeatedly have done deals of that scale and size, because I think it's quite rare, if it's been done at all. So, the model has shown itself to be tremendously flexible in, allowing searchers to do the types of deals that they get excited about doing and leading the types of companies that they want to lead. On top of that, it is an amazing model for incorporating a variety of different perspectives, which is one of the exciting things about it. When people venture into the search fund space and choose to leave the employment model, it's like incredibly scary. And we recognize that. And choosing to do that in partnership, not just with one party or two parties, but in partnership with 15 people, almost all of whom have had a tremendous amount of experience in the search fund space, either being an operator like Greg and David, or being an investor, in dozens, in some cases hundreds of searches over the last 10 to 20 years. It provides that level of, I think, comfort that you get in the traditional search model.
And Drew, your thoughts on cons?
Yeah, absolutely. I mean, I think that there's a lot of compelling reasons into all of the different opportunities that are available to anybody who wants to do this. There are limitations and benefits to each path here. I think it's, to characterize investors as completely self-serving and inflexible and also unable to contribute anything beyond just capital is kind of a short-sighted view. So I know capital is being commoditized in many ways, but people aren't. So when you have individuals who are actually writing the check and providing the support, ask yourself, what would you like to have surrounding you as you go lead the growing company? And if it's just you, self-funded is your path. If you want to have a community of fellow CEOs and also a group of investors and a professional board, there are paths that I think are worth considering with the traditional route and certainly with an accelerator route. We're not inflexible on the economics. The first deal that we did was north of 25% with a lower vesting trigger on the performance-based equity, and there was no debt on the deal. It was reserving all of the debt capacity of the company for future growth and to reinvest cash flow. So you can do a variety of different approaches to get to where you want to go, and I don't know that there is one superior model. I think each of them have their own benefits, and ultimately, if it's it's kind of who you're wanting to align yourself with, which is probably the most relevant factor.
Hey,
Thank you,
Karen.
Drew.
Hey, Karen, can I chime in here for just 2 seconds?
Yes.
I think one sort of element that's kind of overlooked in all of these frameworks that were kind of described and is very prevalent, especially in the United States, is the use of SBA debt and what that actually means. So the self-funded search is definitely riskier for the searcher in that in order to secure the SBA debt, you have to sign a personal guarantee on all of your personal assets so that the business that you're buying is ultimately backed by you personally. And typically in the traditional model, you'll not use SBA debt and the investors will use their sort of resources to find more traditional sort of lenders for you. And, of course, if you personally guarantee the debt, you end up with a huge chunk of the business in terms of ownership, but it's kind of at that cost. Now, we actually haven't at Searchfunder, but don't take my word sort of for it that it hasn't happened. We haven't heard of any searchers sort of defaulting on that personal debt and being screwed over by that down the line. So while the risk is there, the magnitude of the risk is not really well documented. I don't think it happens very often because the whole reason to have that guarantee is the bankers themselves want to make sure you buy a pretty solid business. But I think that personal guarantee is actually a huge deciding factor in whether people decide to go traditional or self-funded.
Thank you, Mark, for adding that piece to it. Do any of our panelists want to add on to what Mark has said?
I was just going to mention one thing really quickly. Equating, using SBA debt and being a self-funded searcher is a little bit misleading because there are self-funded searchers who do not use SBA debt. So that's one point. There are a lot who do, Mark's point. Another point being, the actual percentage of personal guarantees that are exercised, I think that's a pretty low number. So, Mark already made that point.
We haven't heard of any, but
yeah, it's extreme. Yeah, exactly, Mark. Yeah, it's a very low number. And then the capital that's actually at risk with a personal guarantee being exercised is usually actually a pretty small number. So for example, I live in Texas. None of my retirement accounts, my house, nothing my wife owns, none of that is subject to a personal guarantee. So it sounds really scary, but in reality, it's it's really not as much of a risk as I think people think it is.
So,
yeah, and I want to add,
go ahead.
Karen, if I could, just
quickly,
briefly. So I want to just give credit to traditional and accelerator. I think that, you asked about the cons. We didn't really address the cons. We're always happy to share the cons of self-funded searching, but I first want to give credit. History, like Greg said, there's plenty of data on traditional search. It's proven. It's the most time-tested, proven way to be the CEO of a business. There's no doubt. Focus. You're getting a salary to dedicate. You're not going to be worried about, where's my next dollar going to come from next month to pay rent, right? A self-funded searcher, the biggest risk to them is they're not going to focus. They're distracted. Oh, maybe I'll take a consulting job to help me, shore up some cash flow. I'm not comfortable with my spouse supporting me during this time, right? It's much more entrepreneurial in that way. So I'd say that's an advantage for traditional if you're worried about that. And then size. To Robert's point, yes, you can do it. Are you probably going to do it? Probably not. If you want to go for a larger deal above 10 million in enterprise value, you really need to go traditional. If that's what you want to do, I think the cons, like I said, of self-funded search, you better dedicate, and you have to have a savings, built up to be able to do it. But the ability, it's a completely different human being. It's an entrepreneurial route to go self-funded. You're going to own it. Just totally different type of person. So I don't think it's competitive at all. You should know about the models, learn about them, and then choose what is going to fit with you. What do you want out of life? Pick it. And they're completely different paths. Yeah.
Thank you, Jordan. I know that Drew has to head off. I'm hoping to get one last question in before we go to the Q&A in chat. And our panelists have said that they will stay long. So if you are there and have asked a question, we will get to it. Next, I want to turn to a subject that's near and dear to my heart, which is diversity, equity, and inclusion. Can you talk about efforts that you're making towards greater diversity and addressing the concerns of diverse people who are interested in search funds?
Yeah, absolutely. We are starting to see more diversity in the career path just over the past several years, which is excellent. And we can see that this path is speaking to a variety of folks from different backgrounds, et cetera. And so we are still focused on finding the right fit with us, and we are really excited to be partnering with a immigrant from the Dominican Republic who has literally lived the American dream from moving here in his teens with a single mother and supporting her through college and becoming CEO and running multiple private equity-backed companies through exit. And that is the type of exemplar of what an entrepreneurial kind of path and betting on yourself can really provide for our communities. And we want more of it.
Thank you, Drew. And thank you for being here today. And I want to thank all of our panelists. Thank you. I'm going to now turn to Tiffany to talk about DEI with endurance.
Yeah, sure. Happy to. And I'll second what Drew said. I think, this is something we care deeply about. I personally care a lot about it. I come from private equity, and there's very few women in private equity, so I know how that feels. Recently, I had a discussion with a very talented, extremely talented woman who was looking to get into search, and just talking about the challenges of seeing so few former people like herself who've gone down this route. I do think, though, to Drew's point, to the positive, there's more and more examples of people who bring diversity of backgrounds, who are not only choosing to search, but have already had some success being CEOs of these businesses. So for us, we like to play a role in making those connections because I think it's really important for people to talk to other people who have a similar background to themselves to feel confident before choosing to make that leap. And it's a big leap to leave the security of the employment model and go into to the space. So we like to do a lot to foster those connections with what we see is to be a growing group of people who are more diverse coming into search. It's certainly not where it needs to be or anywhere near where it needs to be, but we are seeing some progress and very keen to continue fostering that.
Thank you. Now I want to turn to Greg for the same question.
Yeah, no, thank you. A really important question and one that we think a lot about. I think, we are thrilled by the sort of ethnic and racial diversity of the searchers and partners that we have, built with Footbridge. I think the area that, and we do have a female searcher that we're working with. I think the area that, I feel like, needs more, it all needs more time and attention, but the sort of gender diversity is something that, and getting more women into search is something that, I think seems to be moving slower, and slower than any of us would like. I welcome any and all thoughts from the community about how to move that in the right direction. But it's something that if you look at the Stanford study, for example, I mean, it's pretty disappointing, and there is progress, but I just don't think it's nearly fast enough.
Thank you, Greg. We'll turn to Robert and Jordan as well.
Yeah, I'll comment that actually one of the first searchers that I advised on was an African-American searcher, and he closed the best self-funded search deal I've ever seen. So, I would just encourage anyone who's a minority or has a diverse background, do not let it at all hinder your interest in this space, because there's a ton of opportunity here. There is such opportunity. So in addition to that, I'll add, I'm working with I'm working with an African American searcher right now, and he's extremely talented searcher, and he's already got 3 deals under LOI. They're fantastic deals. One's got 2 million of EBITDA. We're super excited about it, and I think he's going to knock it out of the park. So just definitely, if you got a diverse background, it's only a positive.
Thank you.
Yeah, those are outstanding examples. And I was just going to say they're outstanding examples. And I think I speak for all of us panelists that, I mean, it's really just about your dedication. Just get out there, get as much support as you can to fill those gaps and find good deals. And there's plenty of capital that will happily fund your deal and back you. I think that's what it's about. But yeah, we have some good early wins for Search Investment Group, and there's opportunity everywhere. So yeah, great question, Karen.
Thank you. I'm going to add all of our panelists now, and I lost Greg, but I will find him. Oh, there you are there. So it's just Tiffany. I will add you too. Mark, I'm hoping that you have some questions queued up and we can tag team on that.
Yeah, so I think so I'd like to start I'm scrolling back to the beginning. Some of these have already been answered by the panelists. I guess here's one. A question for sort of these, both for the self-funded and the traditional investor when it comes to backing the searcher. What do you tend to look for in the career background of a searcher as part of your decision process? And I know each investor might have something different to say about it. Okay, I guess we can start with Greg.
Sure, happy to. We're really open. We really try to get to know the person, and that could come in, with different career experiences. We work with people with, mostly just operating experience, finance experience, consulting experience. It really runs the gamut, and we, because we back a few searchers per year, we really, spend a lot of time getting to know the person and going a level deeper than just what you see on the resume. And unfortunately, I do have to go hit the road. Looks like there's going to be traffic going to my meeting 2 hours north. But I just wanted to end by saying thank you, Karen. Thanks to the other panelists. And despite some of my comments, I do encourage people to do self-funded all the time. Not as a default, but if the circumstances seem to align with their goals. So thanks, everybody.
Thank you, Greg. Thank you so
Greg.
much for
Greg.
being here today. Thanks. Much appreciated.
Mark, maybe I'll pick up a little bit where Greg was going. For us, it's less around career background and more about the characteristics that we think will enable them to be successful. You can see some of that, in things like career progression or being at, kind of more selective firms, being in career paths that, maybe had some level of intensity to them. But for us, it's really around discerning sort of a certain level of horsepower and intellect, and then understanding of the search fund model, the 3 of which we think, are really critical to be successful at what at the end of the day is sort of a decathlon of sorts to get a deal done and then to be a CEO of a business. So it's less around kind of looking at specific firms or certain types of career paths, and more around, trying to understand whether those characteristics are there and this is the right path for someone.
So I saw a question in the chat, and essentially it is, so say I want to own the business for the rest of my life. Does that mean that I have to go the self-funded route?
I can take that, Karen. Yes, there's no doubt. I mean, you can't. Well, so another thing too, and it's just, Greg's right. I mean, I am sure he He never felt like an employee a day of his ownership, his operation, I should say. And that's awesome. And that's an incredible experience. I also worked for a traditional operator, outstandingly successful, shockingly successful, equity wise. And I've talked with other traditional searchers who also, I guess let's just say they completed their term and were let go by the investor group and replaced. So it's kind of out of your control at a certain point. I mean, if you're great, they're going to keep you, and they're going to reward you and everything. And it's an awesome experience. But even if you do okay, they might still replace you because they go, well, we're going to tag this company with another company and tie them together, and that person's going to become the CEO, and you're now going to become a director. And if you want to stay, and it can become like that. So, if you want to own a company for the rest of your life, even if you don't want to run it, you'll still own it. You got to go self-funded or start your own company. But that's really our competitor, is somebody who wants to start their own company. It's not a traditional searcher. Traditional searcher, if they don't want to, eat ramen noodles and save money and put their life's work into blood, sweat, and tears, then they're more of a traditional search model person.
Tiffany, do you agree on that? Because I would think that somebody could try to recap to basically buy out investors if need be.
Yeah, we've certainly seen some examples of that. The interesting thing is, despite all of this discussion of it, what generally ends up happening is it's the searcher who comes to the investors after a period of time, and they're the ones who are looking for some level of liquidity, and they're the ones who say, hey, I want to get off the train. And we say, if you want to get off the train, it's time for us all to get off the train. That's usually how the conversation goes, ironically, where it's the searcher who's pushing for that level of liquidity, after a 5 to 7 year period of time. The other alternative that sometimes happens is searchers end up staying on. And that's actually happened, very frequently, particularly when they're selling to private equity firms, whom I think are very excited to have, this level or caliber of talent running these businesses. So they stay on, they're recharged, and then they're running an even bigger business. And we've seen that several times where now the search CEO is running, a $500 million business. Which again, I'm not sure you see all that often, in the self-funded space. You see other things, and certainly, maybe some of these examples where people can, run the business for a very, very long period of time and fully own it. But in terms of having, a bigger or a piece of a bigger pie, I think you definitely see that happening in the traditional search space.
So I see, Jordan, you were shaking your head there a little bit. I couldn't tell if you were just listening or what. Do you have anything you want to add?
Oh no, not really. I was actually looking at my phone because I'm dialed in audio wise on the phone. So Tiffany,
Okay.
I know it looks like that, but I was looking over to the side.
Yeah.
I do see some chat where someone's saying disagree and things like that. And you can recap. You can just think about the environment in which that would happen though. If you're wildly successful, let's say you're really successful, which you want to be, how are you going to recap that from your investors at a low enough purchase price such that you're going to be able, I mean, it's like backing into that. Now, if your company is doing like middling, it's okay. And all the investors are like, okay, it's kind of time. Like we want to get a return here. You could do that under that scenario. I could see that. These are all contingency cases that, if you're a self-funded searcher, by default, you will own, by default, you already own it. And there's no contingencies, but no doubt there's all sorts of different ways you can end up in similar spots. And like I said, you absolutely can buy a bigger company with traditional or accelerator. There's no doubt about that. If you want to go buy a $5 million EBITDA company and then step in as the CEO and get compensated with equity, you go traditional all day. Absolutely.
So that is all the time that we had allotted. I know that there's some additional questions in the chat. There's one on cryptocurrency that is not part of the subject of this panel, so I'm going to skip over that. But what I will do is send the chat questions to our panelists, and if you want to answer them further on Searchfunder, I'm sure that folks would be delighted to have you do it. I want to also give you an opportunity to just say a closing remark or something, maybe something we weren't able to cover if you would like. I'm going to start with Tiffany, and then we'll do Robert and then Jordan. So Tiffany, feel free to go ahead if you have any closing thoughts.
only thing is, Karen, you mentioned this at the beginning, but we do have a website. One of our founding principles is open source. So we make available some 250 plus search-related resources on our website that are available for anyone who's pursuing any type of search, self-funded, traditional, accelerator, et cetera. So we encourage you to check it out, and hopefully they can be helpful to you. And also happy to have a conversation with anyone who's interested in pursuing any type of search. Although traditional search is the majority of what we've done, we actually do have an openness on the self-funded side in the right situation. So very happy to talk to anyone interested in searching in any form. And thank you again, Karen, for organizing this. Very much enjoyed it.
Oh, my pleasure. Thank you for being here. And if you wouldn't mind putting your contact info in the chat, I'm sure people would be happy to reach out to you as appropriate. So, Robert?
All right. So my closing argument is not going to be very satisfying, likely, but I'm just going to talk about numbers really quickly. And now that Greg is no longer on the call, I'm going to attack his model. So first of all, I think to me, that was probably the best argument made for why you would want to do a traditional search versus a self-funded search. And unfortunately, the assumptions in that model were, in my opinion, wildly inaccurate. So the first one being that didn't even consider cash flow. So you've got cash flow every year. And if you own 80% of the business when you buy it, that's a lot of cash flow, right? That you're getting as a searcher. And that model completely ignored that. So if you just take that model, I don't know if he sent it out, but if you ran the exact same numbers, which I did while we were on this call, or on this meeting, and you assumed 80% of the cash flow going to the self-funded searcher, the numbers change significantly, obviously, in the other direction. The other point I'll make is most self-funded searchers don't even keep 25% of their, most funded searchers don't even keep 25% of the equity. So that's not the rule, and in fact, it's more the exception. So, and you can look at the Stanford study, look at what the outcomes are for funded searchers. 30% of them don't close the deal, and of the ones that do close the deal, another 30% don't even make 2 times on their equity. So look at the statistics. But other than that, if you guys have an interest in doing a self-funded search and want some support, Search Investment Group would love to work with you.
Yeah, I guess Karen, I'll close out. Yeah, Robert and I were talking about this. I'm just going to hammer this one more time. If everyone always says this, if you wanted to start a company, but you don't have an idea, go do a search fund. I completely disagree. If you want to be a CEO, but you don't want to climb the ladder, go do a traditional search fund. It's a different question. If you want to be the owner of a business, i.e. a startup where you own 100%, let's say you raise some outside capital from venture, what have you, some angels, where you're still, what the Bumble woman, she sold or went IPO and she still had 70% of the company? That was her company, right? So if you don't have that idea, for that dating app or what have you, that you're going to build up into a multi-billion-dollar valuation, but you do want to jump into a company, own it and run it, and have an opportunity to see every last drop of your sweat be returned to you because you're the equity owner and you gain that, then self-funded is the way to go. There's no doubt about it. But I think it's an outstanding path. All of these paths are outstanding. They're so special. It's not like you have to go back into Goldman or Morgan Stanley and just kind of climb the ranks, which is tough. It's a pyramid, and if you can use your leadership skills and your energy and passion now, I think we all agree that you need to go into search. But again, it's such a different person. The only downside of self-funded search I see out there is that anybody can do it. There's no pre-filter. So everybody says they're a self-funded searcher when they spend 1 hour a week on a broker website. That's not self-funded searching in our view. When we think of self-funded searching, you burn the ships and you're going, and you've saved your capital. You're watching it dwindle month over month, but that's entrepreneurship. That's what you do when you're in a startup. You're bootstrapping your own ownership of your own company. Completely different. So thank you, Tiffany, and to Greg and Drew. It was just an excellent panel. So thanks, Karen and Mark.
Thank you, guys.
Yeah. Thank you so much for being here, and I loved the discussion. I hope that folks found it as invaluable as I did, and appreciate that. And I look forward to communicating more with folks about these important questions on Searchfunder and at our ongoing and upcoming sessions. Thanks again. I'm going to stay on in case folks have questions about what is a search fund, what is Searchfunder, where to find something on Searchfunder, and how to do something on Searchfunder as well. So thank you again, everybody, for being here. Want to really thank our panelists for a wonderful discussion. And Mark, you feel free to add anything you'd like to add as well.
Um, uh, yeah, thanks everybody for coming, and really, really good sort of heated debate between the models. I think next time we will probably have maybe a longer session. It seems like there was a lot of questions that weren't answered, but we are planning to put on sort of like a full length conference sometime this summer, and that's kind of in the works. So stay tuned for that.
Thank you, Karen and Mark.
Thank you.
Okay. Thank you, everybody.
Cheers, guys.
Bye-bye.